Imagine a financial institution built on a grand vision, a bank for the developing world, uniting nations and fostering prosperity. This was the dream of Aga Hassan Abedi, who founded the Bank of Credit and Commerce International, or BCCI, in 1972. From its modest beginnings in Pakistan, Abedi envisioned a truly global bank, one that transcended traditional Western financial dominance, offering services to those often overlooked by established institutions. It promised a new era of international finance, rooted in solidarity and ambition. BCCI's growth was explosive. Within just a few years, it had expanded to over 70 countries, opening branches from London to Hong Kong and across the Middle East and Africa. It cultivated an image of success and trustworthiness, attracting deposits from ordinary citizens, wealthy individuals, and even governments. Its network seemed unstoppable, a financial juggernaut promising lucrative returns and seamless global transactions. On the surface, it was an inspiring success story, a testament to Abedi's charismatic leadership and relentless drive for expansion. But beneath this gleaming facade, a darker reality was taking shape. BCCI wasn't just a bank, it was a labyrinth of shell corporations, offshore entities, and shadow accounts. Its true ownership and financial health were deliberately obscured through a complex structure designed to baffle auditors and regulators. The dream of a global bank had mutated into a global weapon, a discrete financial infrastructure perfectly suited for those operating outside the law. Secrecy was not a byproduct, it was the very foundation of BCCI's illicit operations. One of BCCI's most effective strategies was regulatory arbitrage. By operating across dozens of jurisdictions, each with its own rules and enforcement, the bank could exploit the weakest links. If one country's regulators became too inquisitive, funds and operations could simply be shifted elsewhere. This global patchwork of oversight became BCCI's greatest asset, allowing it to move vast sums of money with minimal scrutiny. It was a masterclass in exploiting the cracks in the global financial system, deliberately playing governments against each other. Crucially, BCCI sought to establish a foothold in the United States, despite facing significant regulatory hurdles. U.S. banking laws strictly prohibited foreign banks from owning domestic institutions without full disclosure. BCCI's solution was simple: acquire banks secretly, using front companies and straw purchasers. This allowed them to gain covert control of First American Bankshares, a prominent Washington, D.C. institution, giving them direct access to the American financial system and, more importantly, to the corridors of political power.
With its global reach and a secure channel into the U.S., BCCI became the go-to bank for the underworld. It laundered billions for notorious drug cartels, particularly the Medellin cartel, transforming illicit narcotics profits into legitimate-looking funds. From South America to Europe and the Middle East, dirty money flowed through BCCI's accounts, purified and disseminated with astounding efficiency. This was not just a side business, it was a central pillar of BCCI's revenue stream, fueling its rapid expansion and its corrupt practices. Beyond drug money, BCCI's tentacles reached into the clandestine world of arms trafficking and intelligence operations. It facilitated weapon sales to rogue regimes and acted as a financial conduit for various intelligence agencies, including reportedly the CIA. These covert transactions blurred the lines between statecraft and criminality, granting BCCI a dangerous level of protection and impunity. The bank was an invaluable, albeit compromised, asset to powerful entities, complicating any efforts to investigate its true nature or halt its operations. To maintain its illicit operations, BCCI systematically bribed officials at every level. From minor regulators to powerful politicians, a vast network of influence was established. This corruption ensured that audits were superficial, investigations were stalled, and crucial information remained buried. The bank effectively bought itself immunity, building a protective shield of complicity around its criminal enterprise. For years, the truth was suppressed, sacrificed on the altar of political expediency and personal gain, allowing the fraud to fester and grow. Inside BCCI, a bank within a bank operated, specifically designed for illicit activities. This secret unit, known as the Black Book, handled transactions for clients involved in everything from terrorism to illegal arms deals. It kept separate records, further obscuring the true scale of the fraud and isolating the criminal elements from the supposedly legitimate operations. This internal segmentation made it incredibly difficult for even senior management to grasp the full extent of the deception, fostering an environment of plausible deniability. The bank's connections reached the highest echelons of American power. Among the most prominent figures entangled in the BCCI web were Clark Clifford and Robert Altman, prestigious Washington lawyers and former government officials. They became chair and president of First American Bankshares, the institution secretly controlled by BCCI. Their involvement lent an air of respectability to BCCI's operations, making it harder for critics to raise concerns. Their prestige was a valuable shield, deflecting scrutiny from the bank's true nefarious nature.
Despite the elaborate cover-up, cracks began to show. Auditors, particularly from Price Waterhouse, raised persistent red flags about BCCI's opaque structure and suspicious transactions. Internal whistleblowers tried to sound the alarm, risking their careers and their safety. However, these warnings were often dismissed, downplayed, or actively suppressed by those who benefited from the bank's illicit activities. The sheer complexity of BCCI's global operations and its political connections made it incredibly challenging for anyone to piece together the full picture. The relentless pursuit of justice eventually found its champion in Robert Morgenthau, the formidable district attorney of Manhattan. Undeterred by the bank's powerful connections, Morgenthau launched his own independent investigation in 1988, focusing on BCCI's money laundering activities in New York. His team painstakingly pieced together fragmented evidence, slowly unmasking the bank's criminal enterprise, despite fierce resistance and threats. Morgenthau recognized that this wasn't just another financial fraud, it was an unprecedented global crime syndicate. Simultaneously, Senator John Kerry, then chairman of the Senate Foreign Relations Subcommittee on Terrorism, Narcotics, and International Operations, initiated a separate investigation. Kerry's team uncovered BCCI's deep connections to international arms dealers, drug kingpins, and even terrorist organizations. His groundbreaking report, published in 1992, detailed how BCCI had been an indispensable financial hub for some of the world's most dangerous actors, exposing the geopolitical dimensions of the scandal far beyond mere financial fraud. As investigations intensified, the true scale of BCCI's accounting fraud became horrifyingly clear. The bank had created a web of fictitious loans and shell companies, shuffling money between accounts to give the illusion of profitability. Assets were inflated, liabilities were hidden, and billions of dollars simply vanished into thin air. It was a Ponzi-like scheme on a global scale, sustained by an endless flow of new deposits and the careful manipulation of its complex structure. The financial statements were pure fiction. Finally, the pressure became insurmountable. Regulators across the globe, led by the Bank of England and the U.S. Federal Reserve, decided on an unprecedented coordinated strike. On a single day, regulatory bodies in dozens of countries prepared to simultaneously seize BCCI's assets and close its branches. This synchronized action was deemed necessary to prevent a chaotic bank run and to contain the contagion that could ripple through the interconnected global financial system. The moment of reckoning had arrived after years of evasion.
July 5, 1991. This date became known as the Black Friday for international finance. In a dramatic, synchronized operation, regulators descended on BCCI branches in 62 countries, seizing assets and shutting down operations overnight. The news sent shockwaves through the financial world, with depositors scrambling to retrieve their funds only to find the doors locked. It was a stunning demonstration of regulatory power, but also a stark reminder of how deeply the bank's corruption had penetrated global commerce. The immediate aftermath was one of chaos and despair. Depositors, many of whom were small businesses, charities, and ordinary families, suddenly found their life savings frozen. Development projects in third-world countries, funded by BCCI, ground to a halt. The contagion spread as banks that had dealings with BCCI faced liquidity crises. The scale of the financial hole became apparent, revealing losses estimated at over $13 billion, making it one of the largest financial frauds in history. The fallout was truly global. Governments scrambled to assess their exposure, while international courts grappled with the unprecedented legal complexities of a multinational collapse. The trust in international banking was severely shaken, forcing a reevaluation of oversight mechanisms. Even powerful nations found themselves caught in the net of BCCI's collapse, highlighting the interconnectedness of modern finance and the ripple effects of such a massive systemic fraud. The cleanup would take years, even decades. The legal battles that followed were monumental, stretching across continents for years. Prosecutors faced the daunting task of unraveling BCCI's intricate web of shell companies and offshore accounts to recover assets. Extradition attempts were made, and some key figures were arrested and convicted, including Aga Hassan Abedi and his deputy, Swaleh Naqvi.
However, many of the powerful individuals who facilitated or benefited from BCCI's crimes managed to escape justice, disappearing into the shadows they had helped create. Beyond the billions lost, there was a profound human cost. Small businesses collapsed, development projects stalled, and countless individuals lost their life savings, often in countries with limited social safety nets. The promise of a bank for the Third World had instead delivered financial ruin and profound betrayal. The scandal shattered trust not just in financial institutions, but in the systems meant to protect ordinary citizens from such vast schemes, leaving a lasting scar on many communities.
One of the most unsettling aspects of the BCCI story remains the persistent questions about intelligence agency complicity. Reports suggested that various intelligence services, including the CIA, had used BCCI for covert operations, providing the bank with an unofficial shield. This raised profound ethical dilemmas. Did governments tacitly allow or even encourage BCCI's illicit activities for geopolitical ends? The answers remain elusive, hinting at a murky world where national security interests intersect dangerously with global crime. Despite the exhaustive investigations, many key figures and architects of BCCI's fraud were never fully brought to justice. The sheer complexity, global reach, and political sensitivity of the case allowed numerous individuals to evade prosecution or receive lenient sentences. This failure to hold all perpetrators accountable fueled public cynicism about the fairness of the legal system, particularly when powerful elites are involved. The full truth of who knew what and when may never completely emerge. The BCCI scandal served as a brutal wake-up call for international banking regulators. It exposed critical vulnerabilities in oversight, especially regarding cross-border operations and the need for greater transparency in ownership structures. In response, global efforts intensified to combat money laundering and strengthen regulatory cooperation. New laws and agreements, like the Basel Accords, aimed to prevent such a catastrophic institution-wide fraud from ever happening again. The lessons were hard-learned, but vital for future financial stability. The Bank of Credit and Commerce International stands as a monumental case study in systemic corruption and unchecked financial power. It wasn't just a rogue branch or a few bad apples. It was an institution built on deception from its very foundation, exploiting trust and regulatory gaps on a global scale. Its story demonstrates how charisma can mask criminality and how a lack of coordinated international oversight can enable a shadow economy to flourish, undermining legitimate commerce and national security alike. The legacy of BCCI is a stark reminder that in the interconnected world of global finance, vigilance is paramount. The allure of quick profits, the complexity of international transactions, and the constant pressure to innovate can create fertile ground for new forms of fraud. The story of BCCI compels us to continually question, to scrutinize, and to demand transparency, ensuring that the dreams of financial prosperity are not built on the shifting sands of deception. Only then can we truly safeguard our economic future.